Picture this for a sec. It's 1998, and you're throwing your cash into the market. The internet's blowing everyone's minds. Startups are launching left and right, and every investor's like, yo, I just found the next Amazon. So you go all in on some tech stocks just because they got doublequotes.com slapped on the end, and for a minute there, your portfolio's skyrocketing. Everyone's calling you a straight-up genius until 2000 hits. When everything crashed, the NASDAQ tanked nearly 80%. And less than half of those .com companies even made it out alive. I personally saw homies lose millions overnight, and even though I kinda saw it coming, my own portfolio still got hammered. Here's the wild part though. The internet actually was the future. But the hype and ego inflated one of the most insane bubbles ever. So why am I bringing this up? Well, flash forward to right now, and I'm getting that exact same vibe all over again. But this time, it ain't the internet, it's AI. Everybody's screaming, it's a once-in-a-lifetime shot. And hey, maybe they're not wrong. Or maybe we're just watching history repeat itself with a fresh coat of paint. History doesn't repeat itself, but it definitely rhymes. Every generation swears they've discovered some brand new era. But like John Templeton dropped, the 4 most dangerous words in investing are "this time it's different." But yo, is it actually different this time? Look, over 7 million of y'all started putting money in the market because of my content. So I feel like I owe you my real, unfiltered opinion on what's going down. Before you freak out, let's pump the brakes and break down the 3 hidden forces fueling this possible bubble. We'll cover why they're a big deal and how you can actually profit from this chaos. Let's dive in. Right now, the entire stock market, including your money, is basically being controlled by just 7 companies. They call M the Magnificent Seven: Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia. These 7 make up about 36% of the whole S&P 500. And they're locked in this crazy arms race trying to dominate AI. So even if you just own a single share of an S&P index fund, you're already riding with these giants. Whether you know it or not, your returns depend on how this whole thing shakes out. Every dollar they drop sends shockwaves through the entire market, from chip manufacturers to energy stocks to your basic index funds. And bro, when you see how much they're projected to dump into AI this year, you'll get why this matters. Let's break it down one by one. Tesla's dropping $5 billion on self-driving tech and XC, which is Elon's new AI venture. Apple's spending $10.7 billion trying to make Siri actually useful. Honestly gonna take way more than that. Meta's throwing $60 billion at data centers and that metaverse thing. Google's putting up $75 billion to rebuild the whole internet with AI. Microsoft's investing $80 billion in OpenAI and building supercomputers. Amazon's going all-in with $100 billion on AWS to basically own the infrastructure everyone depends on. That's $330 billion in a single year. For context, that's more than the entire economy of places like Finland or Portugal. All that bread's getting poured into building tomorrow. Some folks are calling this the 4th Industrial Revolution. I mean, I get it. Sounds hype, right? But here's the thing. All this spending is pretty much what's keeping the economy from tanking right now. Without it, the US would probably already be in a recession. So the real question is, how long can this last? Doesn't look like it's stopping anytime soon. Global AI spending's supposed to hit $500 billion by the end of 2026, and spending on electricity and power resources for AI could top $3 trillion a year by 2030. That's how badly these companies want to win. And honestly, I see why. The International Monetary Fund says about 60% of jobs in developed countries are at risk of being transformed or straight up replaced by AI in the next few years. So whoever cracks this tech first is gonna have insane power. Even Zuckerberg said, if we burn through $200 billion and it doesn't work out, still worth the risk. That's because if they move too slow, they're out of the game completely. But this ain't just companies competing anymore, it's countries. The US and China both see AI as the key to running the world, and they're both burning billions to make sure they come out on top. For regular investors like us, this could go one of two ways. If AI delivers, the next decade could be like the internet boom of the 2000s. But if the profits don't show up fast enough, the same stocks pumping up your portfolio today could tank it tomorrow. So where's all this money actually coming from? That takes us to the second hidden force. This is what people are calling the AI money machine. And it's low-key the main reason I'm starting to worry about where this whole industry's headed. Let me walk you through how it works. Intel, AMD, and NVIDIA. These are the companies designing the chips that power AI. OpenAI, xAI, and smaller players buy those chips. Then you've got Oracle and CoreWeave. These are the data centers that also buy chips and then rent out computing power to the AI companies. Think of them like middlemen. At first, looks totally normal. But once you peek under the hood at how these companies actually work together, red flags start popping up everywhere. Let me show you what I mean. It kicked off when Microsoft gave OpenAI $58 billion in funding. OpenAI then paid Microsoft right back to use their data centers. Microsoft used that cash to buy NVIDIA chips. Then NVIDIA invested back into OpenAI. This lets each company record that money flow as revenue, which obviously pumps up their stock prices. It's kinda like if I went into the woods with a homie, paid him $1,000 to dig a hole. Then he paid me $1,000 to fill it back in. Now we both got $1,000 in revenue. If we got valued like OpenAI, which is trading at over 40 times its revenue, our little digging business would suddenly be worth over $4,000 each. Obviously, I'm oversimplifying. These companies aren't just passing the same cash around in circles. But the core idea is the same, and it's only gotten crazier. OpenAI just announced a $300 billion deal with Oracle. After that, Oracle said they'd spend tens of billions on NVIDIA chips. Then NVIDIA agreed to invest up to $100 billion back into OpenAI. But to unlock that investment, OpenAI's got to buy more of their chips. NVIDIA's the real MVP here. Their stock's up 1,600% since ChatGPT dropped. And they sell to everybody: Microsoft, Meta, Google, Amazon, OpenAI, Oracle, you name it. Then they turn around and invest back into the same companies buying their products. It's like paying your customers to buy from you, which could be artificially inflating demand. See how messy this is getting? Let me make it simple. NVIDIA sells the shovels. Oracle provides the land. OpenAI digs the mine. And they're all hyping each other up to get people investing in the gold rush. But nobody's actually struck gold yet. I mean, OpenAI's valued at $500 billion, but only pulling in around $12 billion in revenue. And they're losing money every month. That's the biggest problem I see. AI services just aren't making enough cash yet. So will these AI companies ever make the kind of profit that justifies these insane stock prices? It's possible they still got some major moves they can make. Over 700 million people use ChatGPT every week. That's a ton of eyeballs, and more importantly, a massive amount of data on all of us. Imagine when Sam Altman flips the switch on ads and lets companies use ChatGPT to pitch products right in our conversations. Could be unlike anything we've seen. Plus, OpenAI just announced they're going to allow adult content for verified users, which, that's a huge market. On top of that, these AI companies are building systems designed to replace human workers. They're betting that once corporations get hooked on AI, they'll have no choice but to keep paying. And that's when AI companies jack up prices and finally cash in. So yeah, these companies are valuable. But a lot of that value hinges on one thing: the belief that progress keeps accelerating. Which brings us to the third hidden force. And this one's a real game changer. It's called the data wall. AI's been leveling up at a crazy pace the last couple years. I mean, we went from AI video that looked like this to this. It's wild that Will Smith eating spaghetti became our benchmark for judging AI progress. The stock market's betting heavy that this rapid improvement continues. But we're getting close to hitting something called the data wall. For years, AI's been eating up every piece of public data out there. By 2027, it's expected to have consumed basically all human-generated online content. It's like climbing a ladder in Snakes and Ladders. Everyone assumes the ladders keep going up, or running out of rungs. Think about how long the datasets we're feeding AI took to build: centuries. No wonder progress seems so fast. We've been feeding it books, research, and data going all the way back to the dinosaurs. And I'm not talking about me. If AI companies can't figure out how to scale past this data wall, we could see progress slow down. Expectations could crash, and the bubble everyone's banking on could finally pop. So the question is beating the data wall even possible? Maybe, but it requires a totally different approach. Think about it. Humans don't have this problem. That's because we don't just learn from being fed information, we learn by interacting with the world. If AI tried to make this video, it couldn't. It hasn't lived my life, had my conversations, or made my investing mistakes. My perspective comes from experience, something AI can't replicate. So in my opinion, scaling past the data wall is possible, but it's not about more data. It's about different data. But look, I'm not a scientist, so let's get back to investing. Which brings me to the big question: what should you actually do with your money? I started this video comparing what's happening now to the dot-com bubble of the late 90s. But is it actually the same? Not entirely. The big difference is these AI companies have real usefulness and a clear path to profits. How big those profits end up being is still TBD. But it's way better than the dot-com bubble where companies got wild. Valuations just from having a cool name. So does that mean it's not a bubble? Honestly, I still think it is. The signs are all there: overvaluation, sketchy revenue reporting, geopolitical drama, and scaling issues. But there's no way to know what stage we're in. This could be the beginning of a decade-long run, or we could be way closer to the end than we think. So, what's the move with your money? Look, I'm not a financial advisor, but here's what I'd focus on if I were you. These strategies helped me survive and profit from the dot-com crash, and they could help you navigate whatever's coming next. First, keep investing. If we're at the start of the bubble, today's prices might look like steals in a couple of years. That's why it's critical to set up automatic investments that leave your account every month into a broad, low-cost index fund. I did this during the dot-com crash, and yeah, my investments took a hit when it popped, but I don't regret it one bit. Over time, the market bounced back, like it historically always has. The real trick is don't panic when your portfolio drops. As long as you're in an index fund tracking the overall market, continuing to invest during a crash could be the best move you ever make. That's how I ended up making millions from the dot-com bubble bursting. But to pull this off, you need to make sure you're not in debt or over-leveraged. That's exactly why my friends lost millions while I kept investing. Make sure you've got an emergency fund and you're not using money you need in the short term. This is the foundation of wealth building during uncertain times, and it's probably the most important thing you can do. But there's more you should be focusing on. Second, boost your income. Your income's the fuel growing your wealth. If you can level it up with a promotion or side hustle, that's going to supercharge your returns. And this is especially powerful if you're doing it while the market's tanking, because you'll be scooping up bargains. More income means more money to invest when stocks are on sale. I've personally built multiple income streams, and it's made all the difference. When one source takes a hit, the others keep you afloat. Plus, it gives you the confidence to keep investing when everyone else is scared. Third, diversify. Throwing all your money into one type of investment is asking for trouble. The key to surviving bubbles is spreading your cash across different assets. My portfolio's got stocks, bonds, precious metals like gold, real estate, and even some crypto. Also consider dividend-paying stocks, They actually do well in downturns because they generate passive income even when prices tank. Diversification isn't about maximizing returns, it's about surviving the worst-case scenario. And when you survive, you're in position to thrive when things recover. Just remember, this bubble popping won't be the end of the world. If you understand situations like this, you won't be the one panicking. You'll be the one taking advantage while everyone else is running for the exits. This is how generational wealth gets built. Not by avoiding crashes, but by being prepared for them. If you want to learn how to profit from a recession, I'm going to drop that video right up there. But don't click yet. Hit subscribe if you're trying to grow your wealth. Right, catch you over there.